To cloud. Hello, everyone. Welcome back to another week live with Caeli Ridge from Ridge Lending Group. Every week, every Tuesday, we get together here online to discuss all manner of things. Starts at 4:30 p.m. Eastern, 1:30 p.m. Pacific. And you'll always find the most recent link at the Ridge Lending Group community, which is community.ridgelendinggroup.com. As always, you can ask any questions by taking yourself off mute, or certainly use the chat feature within the meeting. For those listening on playback, be sure to tune in every time we post an updated episode. And today's episode is we're going to crawl into Caeli's head, and we're going to make her relive all of her investing experience back from the beginning. When she first learned how to invest in real estate, which I'm pretty sure was age 3. I don't know, we'll have to ask her, but we're looking forward to finding out what her experiences were from the very beginning, kind of midlife of real estate investing, and then where you are today, Caeli, and what you would do if you were a real estate investor, which I know you are, with today's changes in the market. So here's Caeli.
Thank you, Larry Bailey. Hi, everybody. Looks like we've got a nice intimate group. I actually like that. I prefer it. I think it adds to some back and forth. If you guys have questions, like Larry said, feel free to chat or just unmute yourself. Let's just kind of make this an open forum. So I want to start by just offering that an overview of real estate as an investment, and similar to most investments, is cyclical. And I think in particular, real estate holds a very cyclical kind of background. And I've been around long enough to have seen several of these cycles now. So I do think I have some unique perspective that hopefully from my own personal experiences can add to your education and needs and decisions to move forward so that you're informed, right? All right, so let's see. I'm going to take you back in time about 400 or 500 years ago when I was 3. And just give you an idea of where I started. So most of you listening probably know that Ridge is a multi-generational company. My father had started and founded the company before he retired officially in about 2005. I was kind of running things before then, but he's the one that sort of spearheaded this non-owner occupied niche that Ridge found itself in. Getting into mortgage, he learned pretty early on that he didn't want to be competing with the masses on the owner occupied side, because, the puddle pool was just, it was too big. So he wanted to differentiate himself. He ran into an individual named Marshall Reddick, actually, which is an economist in Southern California that focused a lot on real estate. Anyway, the two of them hit it off. Long story short there, as they started to invest together, I kind of came in within a year of that, and we really started to grow the business and focus on the residential real estate side of lending. There wasn't really an outlet for that. You just go to your B of A or your local credit union or whatever. There really wasn't a national lender that was able to accommodate the needs of real estate investors, especially on any scale, right? Where you're looking to purchase 1 or 2 or 3 or 10 or whatever. And back in the day, so let's go back to the early 2000s and kind of talk about that cycle of real estate and the rules associated. So this is pre the 08-09 crash, right? If anybody is old enough here on the call to remember that, in the United States, we had kind of a unique situation where both the lending and housing markets imploded simultaneously on each other. Many of you have probably seen some of the movies, The Big Short, or heard the headlines about what transpired or what happened there. A lot of irresponsibility, I think, from a lending perspective was going on. There were a lot of real estate agents and appraisers in cahoots, inflating values, subprime mortgages. I won't go down that rabbit hole, but just to say that that was a very unique place in our history. I think many people would agree that never to be repeated again as a result of some of the irresponsibility that was happening on the lending side. Most of you have heard that post 08-09, the Obama administration, there were 2 individuals, Dodd-Frank, you probably know those names, last names, came up with a sweeping overhaul of legislation related to all sectors of finance, specific to the real estate side, I mentioned, irresponsible behavior before. I kind of feel like in some ways, some of the knee jerk of what happened going forward after 0809 could be viewed as similarly irresponsible. They really, really restricted. We went from having unlimited access and resource to credit and loans. I mean, unlimited. You didn't have, so right now we've got 10 conventional loans, right? Before the crash, we had borrowers that had 150 loans and properties. If they continue to qualify, they could continue to qualify. So you fast forward after that, and it went from unlimited and a little reckless in some cases. Now, we didn't produce those loans. We didn't do those neg am loans and things like that. We did high LTVs, but we didn't get into the real crazy stuff. But so you had this unlimited availability of credit, and then you fast forward just after 2008, 2009, when, well, I think it was 2010 when all the legislation came about. And you couldn't have more than 4 financed properties conventionally. Credit went from this to almost nothing. And that was a real devastation for a lot of the investors at that point in time, because they had no options, right? The values of their properties were down. They didn't have any access to do any refinances. It was really just kind of a mess. So, okay, let me take it back. So we get into this space for non-owner occupied. We're doing really well. We're really probably of the biggest in the nation for non-owner occupied lenders at the time. And then overnight, the light switch, the implodometer, if anybody remembers that, all the lenders were shut down. And then it was just nothing. So we spent from about 2010 to about, I want to say 13 or 14, working on short sales for our clients, deed in lieu of foreclosures for our clients. The model changed significantly because loans were just being had. And for those of you that don't know, at the height of my acquisition of real estate investing, I held 42 properties. For us, we kind of had a double whammy, because not only were we in the space of lending, right, to investors, we were also investors, right? So when everything blew up, we were kind of stuck with all these properties. And at the time, the cycles that I was talking about earlier, at the time, that particular real estate cycle couldn't have been more different. It was all about appreciation. Very few of my properties actually cash flowed. Now they may be negative by $50 or $100 or some of them and more in some cases, but it was really an appreciation play. The cash flow didn't even come into real estate investing probably until really 2013, 14, when people were able to take advantage of that. I think I'm jumping all over the place here, you guys. So let me see if I can line this up linearly. 42 properties at the height. Once everything kind of hit the fan, we held and held and held. We thought for sure, the government would come up and help us kind of create some way to work through this. And it just didn't happen. So we ended up having these properties that appreciation was very, very high before that particular development in 0809. And then the values, many of you remember, went from here to just through the floor. So I'll give you one example. There was a property that we had in Florida that we purchased, I think, for 1.2 million. And by about 2011, 2012, when we were trying to do these short sales to kind of offload some of this property, I couldn't short sell it for about, I think 330 was the last offer that we had. There was no assistance. If you think about what happened in the last couple of years within the pandemic and the need for people like renters, for example, or homeowners, whatever, to not make those mortgage payments on the forbearance, there was no proof of hardship that was needed in this particular cycle. Granted, very, very specific circumstances were happening, but back then we could show real significant hardship and we could provide that proof, but it didn't matter. There was just nothing that would be done or could be done. So for us, what we found is that after many, many years of trying to do the short sales, et cetera, we ended up having to do deed in lieu of foreclosures in many cases. So the 42 properties that we owned at the height, now translated into 11. So I have 11 of those properties left, from where we started to where we ended up after the 0809 crash. So that's kind of a quick overview of some of my story. What I do want to focus on today, though, is the differences in the cycles, real estate cycles. And it might be important to quickly comment that the two, and I'm just going to focus on today, what we're looking at today, and what it was kind of pre-0809, or let's just say pre-2010. So I mentioned already, appreciation was really what was at play. Properties in certain markets were appreciating by leaps and bounds, even higher than what we're seeing today. And we're seeing a lot of appreciation today. Cash flow wasn't even a thing. Adjustable rate mortgages were very prevalent. Interest rates were much higher. Median price points were also higher than what they are today, if we look at a national average. So the cash flow just, it wasn't available. This particular market that we've all kind of been living through has been all appreciation. And I get to see these properties day in and day out, right? I'm looking at the appraisals, I'm looking at the leases, and we're licensed in 46 states. So I get to kind of see a nice coupling of that. I don't see properties that don't cash flow. I mean, whether it's $100 a month or it's a few $1,000s a month, properties will cash flow. So primary differences between that cycle and this cycle, and maybe there was some learning that went on there, is that the property has to appreciate, or excuse me, has to cash flow. Appreciation is nice, and there's certainly a lot of wealth that's going to be built through appreciation. And I think a good balance in a healthy portfolio is going to be important as long as it cash flows, right? If I knew now, if I could go back and make some different decisions, my portfolio would have been more diversified. So one of the primary things that I took away from my post or my pre-life real estate investing, pre-crash investing, is that diversification should have been more about cash flow, appreciation, property types, single family versus the 2 to 4 units. We were diversified in many states, but we definitely, we probably put too many eggs in certain baskets that were already oversaturated. So I would be looking for that now. And the new thing to this cycle that I'm really liking, that I'm seeing, is the short-term rental and the long-term rental, which didn't really exist back then. Not that you could get leverage for anyway. So we're seeing some pretty great gains on the short-term rentals in the different markets that really produce high returns. So I would say that the moral to my story was, and some people might say, well, you got greedy and that's why you ended up with, 11 of those initial 42 after all was said and done. And maybe there's some truth to that. But I think more than anything, the learning lessons for me were invaluable. And as difficult as it was at the time to go through all of that, I probably wouldn't change it now. I probably wouldn't have said that back then, but it just really prepared me to take better advantage and be smarter about my decisions within real estate. And I'm still very bullish about real estate as a vehicle for investing, as long as you are diversified and you have a good balance between all of those different things that I've described. Let me just say them again. So cash flow and appreciation, property type, single family versus 2 to 4, property class, perhaps. I usually won't go below C class. I mean, some people do very, very well in the D class properties. It's just not for me. Market, right? Diversifying in different markets around the country. And then the short-term and long-term also should be something to consider, and keeping that well-rounded pool or portfolio of investments.
I do have a question.
Yeah.
So going back, before we let you get out of the crash situation, going back to when you were building up, the question is, what was it that caused you to want to get into real estate? Was it purely because it was in your family, or did you see something that was interesting to you? Like, what caused you to go down that path? Do you remember?
Yeah, I would say just, my dad and I have always been very close, and just kind of watching him evolve in it. He probably was doing it for a few years before I got into it in general. And then some of the advice of the people that did real estate investing, and being able to see from a tax perspective specifically, and from the appreciation perspective, And I dabbled in it a little bit. So dad would say, okay, we've got this investment here. And I'd give a little bit of money and just to kind of test the waters and see. And the returns were phenomenal. So, I'm 20, Jesus, I'm going to date myself. I'm 27, 28 years old at the time. And, for somebody, and I had dropped out of med school. I went back to school later in life, and I said, a starving student for me just wasn't the way to go. So that's when I went to dad and said, okay, let's look at this together. And I got into a few deals with him, and I was able to see the power of, again, at the time, appreciation. We did very, very well. Double escrows were a big thing back then, where I would purchase it for $100,000 in January. And before I even closed on my loan, let's say new construction, I was selling it for $175,000 in June, right? And I would be able to take that difference and do the 1031 exchange and not pay the capital gains, et cetera. So I think for me, it was just being young and the allure of how much money could be made in real estate. And from then I was hooked.
Okay.
Cash flow, though, would have been very important for me to have more of a balance in my portfolio. So again, going back, that's what I would change.
So some other questions that we're dealing with here is, when you decided to get into real estate and you had some of that, and you were focused on appreciation, did you find that you had to do anything different than compared to what you do now to keep your properties floating? In other words, was it just you just had a bunch of money saved up to keep the properties floating if you weren't working on cash flow?
If I don't answer the question, maybe repeat it or take yourself off mute and repeat it. Back then, remember, the leverage was much higher, right? 10% down, 5% down. I got those loans all day long for myself, where you had high leverage. Interest rates were higher, but we had options to look at ARMs. So, and back then, the adjustable rate mortgage was actually faring better than a 30-year fixed, which is normal, right? Anybody that understands an ARM knows that it's supposed to have a lower interest rate than its counterpart of a 30-year fixed. And that's the way it was back then. Fast forward, we're on an inverted yield. So the adjustable rate mortgages, at least for right now, I'm seeing some writing on the wall that that's going to revert back. But right now, an adjustable is actually a higher rate than a 30-year fixed. That's an inverted yield. So, we had some savings, and at 5% down, it made it quite reasonable to go ahead and get into real estate investing. And because appreciation was so great, we would do cash out refinances. We'd take a bundle of properties and do 3 or 4 or 5 cash out refinances several times throughout the year. Borrowed funds are non-taxable. And those are the monies, the equity that was earned, we would harvest and buy more properties. So in that case, it was probably easier. And then the qualifying was much looser, much easier than it is now, right? Everybody has heard my joke, I'm sure, vials of blood and DNA samples, and you got to walk on water to get loans now. You've got a lot more skin in the game. Reserve requirements are much higher than they used to be. So for that reason, I think that we had it easier than what you guys have now, but for different reasons.
Okay, that's all the questions we've got for pre-crash.
Okay.
So now you've gone through Caeli and you've got it. You've worked through the mess of getting through 08, 09, 10, 11, 12. Figured out how you could liquidate properties. Kept yourself together. Obviously, Ridge Lending Group has never gone out of business. It's still around. It's still kicking. So when did you pivot, and how did you figure out how to pivot?
Well, and this may have to do with my stubborn nature and just the never quit attitude that I think my father instilled in me. So after, it really was a light switch, right? We had unlimited resources and we had all our properties and everything was going great. And then overnight, nothing, right? No access to credit. We couldn't get loans for anybody. It was a very, very difficult time. But in knowing that our clientele was dealing with the same things that we were dealing with, we did have an option and an opportunity to help them work on short sales, which was probably the darkest time of my entire life. If anybody went through that and they had to deal with the lending institutions and try to negotiate short sales or modifications, right? We did short sales and modifications. I'm certain that it cut years and years off my life. It was horrible. Constant display of documentation over and over and over again, only to be denied after a year's worth of work. It was terrible. So we were able to do that. And then slowly but surely, the credit markets opened up a little bit here and there. We were still kind of synonymous with non-owner occupied. Our reputation was still strong because, you know, we, as a company, we've got integrity, right? And that's always been at the forefront of our mission statement for who we are and how we want to present. So, you know, as things opened up a little bit, our clients and you know, the values are still very, very low. We were able to rework things and get back into lending for our investors, because now we've got price points that are much, much lower. Interest rates were a little bit lower, but now we had cash flow, right? And the whole thing kind of switched within 3 to 5 years of 0809. And now we've got new ways in which to maximize our leverage, which was still higher than any other country in the world, by the way, over 30 years. So our cash flow can be there, and start gaining wealth and residual income, passive income, where you can still find appreciation in some markets, but most people were really focused on that cash flow. And in some cases, you know, each property was cash flowing $500-$600. Single family residents were cash flowing that much in different markets. Now that's probably not the case now, maybe on a short-term rental, but not on a long-term rental. And that's where we find ourselves, right? All the way through to now. Now cash flow is going down a little bit. Why? Because obviously interest rates are rising, but maybe what I could offer there is that two things. One, as interest rates rise, what happens to rents, right? We know this historically. When rates rise, rents will rise too. They don't move at the same speed, unfortunately, but they're going to catch up over time. And then the second piece to that is that with rising interest rates, the inventory, we've been in a pretty severe seller's market, right? Everybody's going to agree with that. Inventory has been very, very low, but the rising of interest rates is going to help us in a few ways. One, it's meant to help stamp out a little bit of the inflationary concerns, and the appreciation that we've been seeing over the last couple of years. It's going to help stabilize that. It's not sustainable. So I think that in this way, that's good to kind of slow that freight train down a little bit and keep appreciation more in normal ranges. But more than any of that for us investors is that affordability. So the homeowner that's looking for properties to live in, right, as interest rates rise, they're not going to be able to afford it. They're not going to be able to qualify. So affordability, qualifying, that changes the platform or the playing field so that there will be more inventory available to us investors, right? Because we're taking away a big section or pool of the housing market buyers, leaving it open for us. And what's going to happen to those guys? If they're not buying a home, where are they going to live, right? So inventory is still at a low, but it's going to start improving a little bit. And I think that seller's market might shift, the tides will turn and start becoming a little bit more of a buyer's market where we have a little bit more leverage and negotiation power. Maybe we can negotiate the prices a little bit. Now, keep in mind, you guys, it's very specific to the market. Okay, not every market is going to experience this, that, or the other thing. Anybody that starts to blanket statement something and say that there's a housing bubble nationwide, or that it's, you know, a seller's market nationwide, or whatever the tagline is, if they're putting that blanket over a big demographic, they don't have any idea what they're talking about. It's very, very market specific. Every market is very, very different. I mean, as a stupid example, take San Francisco, which historically is one of the most expensive places on the planet to live, versus Birmingham, Alabama, right? They're not synonymous. There's going to be vast differences between the different markets. So going back to potentially moving into a little bit more of a buyer's market, some of the things that we might be able to negotiate are seller paid closing costs, right? A lot of that hasn't been available. We're more into the bidding wars in most markets, right? If it goes on sale for $100,000, it probably ends up, and I'm just using a round number, it'll close for 120, right? You don't have any options to negotiate the price. You certainly don't have any options to negotiate for the seller to pay any of your closing costs. or you haven't for the last couple of years, but I think that that's going to change in the coming months, 6-ish months. And then we'll see what happens with the feds and what they're going to do with helping inflation. If we go into recession, maybe we get another little boon on lower interest rates. We'll just have to see.
So if you, we do have a couple more questions, but I in the spirit of time here for you, Caeli, I want to make sure that if you could do the proverbial thing of, sending yourself a message in a bottle, right? With everything that you learned, knowing what you did, it sounds like you've got a pretty short list of what you would have told yourself. Forget the crash, right? I mean, there's some people that saw the crash, but pretend the crash didn't happen. What would you have told yourself back then starting out?
Two things. One, anybody that predicted that both housing and lending were going to crash together at the same exact time, I'm calling BS on that. I think that there were some very smart people that were looking at it over here thinking this is going to happen. And then over here, housing and lending. I don't believe that there was anybody really, from my research and what I've looked at, knew that they were both going to happen simultaneously at the same time. And that's why it was so devastating. But I think that if I'm going to go back and talk to Caeli 25 years ago, 25 years ago, diversification. And that's really what I put out there for my clients, really keeping an eye on all the different levels of investing. So I'm going to say them again. So cash flow, appreciation, tax benefit, property type, class, short-term, long-term. I'm probably forgetting one or two, but that's 6 right there. Having a nice balance of each one of these and very specific to the individual's goals, right? Some people are going to be super aggressive. If you're 25 years old, you may be willing to be a lot more aggressive with some of those criteria than if you're 65 years old and just want a couple more properties to kind of keep things easier, right? A little bit of extra cash flow. Maybe you want to take a little bit of money out of the stock market. So depending on how risk averse or aggressive you are, I think answers that question. But big picture, diversification, right? And as a rule of thumb, I'll kind of give you guys, this is just on average, kind of somewhere in the middle, not super aggressive, not super risk averse. But if I look at some of those criteria, let's go cash flow versus appreciation. A lot of people that survived the 0809 and are still here investing, they completely reject the idea of appreciation because of what they went through. Now, I think that's short-sighted. The property has to cash flow, 100%, I agree. But in terms of how you're going to balance your portfolio, as long as it is cash flowing, I usually will say an 80-20, 75-30, where primary objective is the cash flow, but you still reserve, 20, 25% of your portfolio for markets that will offer some appreciation as well. So diversification there. Let's look at another one. Short-term rental and long-term rental. I would say similar, maybe 80-20, 90-10 short-term rental. And this is kind of in the middle, right? Not too aggressive, not too averse in that risk. But I think a short-term rental in the right market with the right property will produce phenomenal returns. Do your research. Single family versus 2 to 4. This one I think is going to be closer to the cash flow and appreciation. So 28 to 30% for single family. And the reason for that is single family will always appreciate quicker, faster, higher. The exit strategy for single family is a better option than if you're trying to load off a 2 to 4 unit. You're probably not going to be able to sell those as fast, although maybe that's changed a little bit because they're so hard to come by and everybody wants them. Maybe that isn't even true anymore. But overall, I would say single family is going to be the least risk averse. So keep 70-80% of your portfolio for the single family and then peppering in 2 to 4. I've got some clients, however, that would dispute that all the way and say they only work with 2 to 4. Here's the flip side to that. If I'm going to play devil's advocate, which is my job, a lot of people would say the 2 to 4 comes with, 4 more maintenance worries and headaches that you have to deal with, 4 more tenants that you might have to chase for your rental income versus just the one family. The turnover costs can be more on a 2 to 4 unit. Let me play devil's advocate back the other way again. One of the nice things about a 2 to 4 is that if you've got a fourplex and one goes unrented, you still have 3 people helping make that mortgage payment versus a single family residence. If that guy goes unrented, you're stroking a check for the whole thing, right? You don't have that extra support. The other thing too, maybe some people are really into the Section 8 and they do very, very well there. I don't have as much experience, so I probably couldn't speak too intelligently about it, but I think to answer your question, Larry, in a very long-winded way, I'm going to say diversification, you guys. Make sure that you have a balanced portfolio, and we can help with that, right? We can look at it with you as it relates to your individual goals and certainly your qualifications, and help you kind of come up with a plan that says, okay, here's an outline. This is where we want to be in 5 years. These are the markets that we are interested in, and then we can start kind of moving the chess pieces.
So we're going to get t-shirts for all of our clients as they close. Ridge Lending Group diversified me. Is that a good one? We should do that.
I love it. I want one. Yes, let's do that.
We have to do that.
That's fantastic.
Oh, that's great. So Emily asks a question. And so thank you very much, Caeli. I know everybody really appreciates you sharing your insights, and we always, love to hear what happened to you when you were, 3 versus where you are today, which is only 30. So
yeah.
You look great.
Thank you.
So Emily asks, you mentioned 1031 coincidentally. So Emily just found out that they sold 2 properties into a 1031, had no guidance that the new home would need to use and it would have to close in the name of the LLC, right?
That's wrong. So anyway, is there more to the question?
So the concern is, of course, now everybody's upset. They didn't realize they had to plan for this. Can Ridge Lending help? What do we do?
Yeah.
That kind of
Hi,
thing.
Emily. I'm sorry. So what she's talking about, everybody, so she sold some properties, right? She didn't want to pay capital gains. So they transferred those into a 1031 exchange, which means you have to take the proceeds from the sale and purchase like-kind property, investment property. So the IRS rule or code within 1031 exchange says you have to take title the way you've left title. Okay, that's the basic language that's written there. I think a lot of people agree that the interpretation of IRS code is subject to interpretation. And if you're dealing with an exchange company that is not going to have any common sense, maybe, and is just going to take it by the letter of the way it's written, maybe that's what's happening, Emily, is that if you sold it as an LLC, they're saying that the new loans that you have to take have to be in the LLC name, when that isn't necessarily the case. We do these all the time. As long as the LLC itself, the people that are going to be on the loan are part of the LLC, or let's say, for example, if it's you and your husband, 50-50 LLC, you sold it, you're going to be on this loan, he's going to be on that loan. As long as the other is on title, you shouldn't have any problems with completing that transaction. Do you want to add some layer of detail to that and share with us? And I might be able to answer more specifically.
Yeah, I'm being told that we sold it as an LLC and we had it at a state level, like it was in Tennessee, and then we have our Wyoming LLC that owns the state level. And he's telling me that I have to buy in the Wyoming LLC in Florida. And I'm like, that's my asset protection going out the window. I can't do that. And I'm just so scared. And I'm worried that the LLC loans are so much more expensive than the personal loans.
Yeah. I would argue with him and say that that's wrong. Like I said, we do this all the time. We sell direct to Fannie Mae. We don't have any issues with, so just to clarify that statement, we're a direct lender in that we fund everything on our warehouse line. We underwrite ourselves. We don't service these loans. So when you guys go out to make your mortgage payment, you're not making it to us. We bundle up packages of mortgage-backed securities and we resell them. The 1031 exchange thing, if you sell it in an LLC, it shouldn't impede you from purchasing properties in your individual name, the replacement properties. And then if you want to put them into the LLC title for asset protection after you close, you can certainly do that too. So how far are you within the exchange? Are you like the 45 days to identify is over? Are you close to your deadline to close?
The first one has through May 19th, and I have just found my second property to, they're actually going to be 2 build to rents in Florida in the same development. So
Okay.
I still have time, but this is plan B. My plan A has already fallen out because you can't buy anything these days. It's so
Yeah.
hard.
Right. Well, I think we have some solutions. If you want to talk offline, I'd be happy to get on the phone and let's find a way forward. It doesn't sound like it's going to be all that difficult. So Larry, will you get, or we'll just give you.
Yeah, we've given Emily the contact information for the
Okay.
office. Anybody else have any questions? You can always send an email into info@ridgelendinggroup.com, or you can call toll free 855-74-RIDGE or 855-747-4343. There were some also some comments, Caeli, just talking about that there are opportunities for appreciation in places these days more than usual. I don't know if again, I know you said earlier about a blanket statement, but you've got to do your research, right? You've got to get the area, you've got to work with professionals in that area before you make any final decisions.
Yeah. And I think what you guys will find too, and there's always exceptions to the rule. Okay. Always exceptions to the rule. But generally speaking, the markets that have the highest appreciation are going to have the lowest cash flow, and vice versa. The markets that have the highest cash flow, you can't expect to see much in appreciation. Balance, right? Diversification and balance is key there.
And I don't know if we covered this exact earlier. I know you were talking earlier, Caeli, about your, balancing out your portfolio between cash flow and appreciation somewhere in, depending on if you're risk averse or risk aggressive. But would you just want to recap that for those that came on late, where you would focus on if you were risk aggressive right now, especially with the way the markets are changing?
Yeah. If you're real aggressive and you want the biggest bang for your buck, I'm going to say that you want to be purchasing new construction in higher appreciating areas and maybe 2 to 4 units. So as an example, a good one would be, and generally appreciation at its highest is going to be found in the Sunbelt states. Generally, remember, there's exceptions to every rule. So, the North or the East and West Coast, the Carolinas, Florida, Georgia, California, you're not going to get, it has to cash flow, right? That would be something that I would recommend. And maybe that's some of my PTSD. I've got clients that have properties that don't necessarily cash flow because they have enough cash flow over here in the rest of their portfolio to make up for it. I'm not super comfortable with that. Again, because of what I've been through, even if it's $50, the thing has to cash flow, right? But if you want to be super aggressive, I'm going to say the higher unit number, 2 to 4 units, more appreciating area, and maybe even the short-term rentals if you can do it. I mean, if you can find a property, a fourplex, for example, in a fairly appreciating market on a short-term rental basis, that's probably going to provide you with the best of all worlds, but it's going to be more aggressive in the risk category. The short-term rental, while I'm seeing amazing returns, I don't know what's going to happen there. And I am hearing that, as different townships and cities kind of start leveling laws against what you can and can't do, that could be very, very problematic for a short-term rental that you've kind of had a free-for-all for, if they start putting restrictions on what you can and can't do. And that's coming. That's what I'm seeing.
It actually just happened. So the law passed in the state of Hawaii. So specifically on Oahu, you have sellers now that are not sure what they're going to do, right, Caeli? Because it's now a 90-day classification for a rental unless you're in specific zones on Oahu, especially. But I mean, yeah, that would just completely upset my day if I just bought a property in the spirit of short-term rental in an area outside the named districts.
Yeah, unless you can assure yourself that, I would check the laws first, maybe if getting into it, you'll be grandfathered in some way, or make sure that the long-term rents, right, would support that price point. A lot of times, just let's stay on this theme for a second, a lot of times the short-term rentals are much higher price points, right? And the average long-term rent will not cover those mortgage payments. So have a backup plan for that property.
Awesome. Appreciate that. I don't have any other further questions in here. As always, if you're listening to this or as you're here today, we want to thank you very much for coming. If you have any other further questions, feel free to post them on the community. Caeli always is happy to respond as needed. And of course, if you want to reach out directly, again, you can either email in to info@ridgelendinggroup.com or call 855-74-RIDGE. And we're always here Tuesdays. And yes, I'm sorry, I'm going to butcher that name. Deltrice. I'm going to go with Deltrice. We always repost these recordings. Typically, it's usually by next day. So I will do my best to get that out for you along with the transcript. Anything else you want to add, Caeli?
I want to hear the pronunciation, just to see how close on the money that you were.
It's Deltrice.
I'm interested. What do you got? She's
Did I get it, Deltrice?
You did. It is Deltrice.
Told you.
nice. Look
Come
at
on.
you.
Give me a
You know,
minute. I'll figure it out.
We have that in common, right? So I am absolutely guarantee you, she has a Starbucks name that is not Deltrice. She probably calls herself Lisa. I'm Jen when I order Starbucks, because Caeli, no one's gonna write that down or get it. So
I'm going
I
to
feel
spell
you,
it wrong
Deltrice.
if I'm at Starbucks and I hear Caeli. I'm going to spell that wrong.
My
Anyway.
Starbucks name is Anderson.
Is what?
Anderson, my husband's father.
Oh,
See,
there you go.
I knew it. I knew it. Yeah, so you guys, thank you for being here. We love that you take your time out of your afternoon, your busy afternoons, to share some space with us. We hope that we continue to provide some good content. As always, please, if you have topics that you're interested in that have any relation to real estate, the financing, whatever, put it in the comment box. There's a section in the community, right, Larry, that they can type in, hey, I'm interested in this, and we'll make sure that
All day long. Yeah,
Okay.
everybody can post a question or post a topic. Absolutely.
Sweet. We'll be here for those, and we look forward to seeing you guys next
Next
week.
Tuesday. We'll see you there.
Okay.
Everybody have a great rest of your day. Caeli, thank you very much. Everybody
See
stay
you guys.
safe. Be well. Bye-bye.